to bring on board Rajeev Mello, who's the head of Asian Fixed Income at Schroders Investment, who joins us on the show now. Morning, Rajeev. Good to have you with us on Morning Mantra. To begin with, what are your expectations from Q4 GDP and GDP for FY12? Do you think we can clock in a 7.6% GDP growth rate in FY13? And how would markets react to that?
Well, I think that, the GDP will probably come out on the lower side of expectations, probably disappoint slightly. The latest 2 months have been weak months. We've seen weakness across Asia. We've seen weakness in Europe as well. We've even seen some weakness coming out of the US. So it would be surprising for me to see growth in India higher than expected. So I would assume slightly weaker growth in India. Yes, if you look at the last 5 years, this is really the low end of the range of Indian growth. But there are all these macro challenges that we talked about earlier, and also there's probably a bit of an inertia on the policy side. Central government does have its hands a bit tied following recent events, elections, and various other events within the country, which make it more difficult to take bolder policy steps.
Right. So, Rajeev, what about FY13? What sectors do you think would be leading GDP growth for the forthcoming year then?
Well, I think the domestic side and the consumer side will grow at a weaker pace, which will continue to grow. I mentioned also that with the weaker rupee, exports could be helped a bit. India's products on the export side will become significantly more competitive relative to many other Asian countries, and also competitive relative to producers elsewhere in the world outside of Asia. So that should help a bit on the external side. And if we move gradually towards a more balanced trade position, that will be a contributor to growth in the future, whether it's the next year and the following year as well.
Also, Rajeev, now high interest rates are hurting GDP. What are your expectations in terms of a rate cut from RBI over FY13, and how do you see inflation and high interest rates impacting GDP going forward?
Well, in terms of the RBI delivered a surprise 50 basis points rate cut the last time, and it seems it took advantage of the statistics, which did point just simple calculations to the year-on-year inflation rate hitting the low in March, and now it's on its way upwards, normalizing again. So the RBI is probably going to be on hold for the next couple of months, but then I do see the Reserve Bank cuts interest rates by at least 50 basis points during the course of this calendar year. As I mentioned earlier, the growth situation has weakened. Inflation will eventually come down. Global inflation pressures are more towards the downside than to the upside, and that they will give room to the RBI to eventually cut rates.
Right. And Rajeev, what's your view on the currency then, specifically for the rupee? How much of the fall do you think is fundamental, and how much of it is due to the strength that we've been witnessing in the dollar?
Well, if I look at the rupee's performance over the last 12 months, it's down about 19%. That's far more than even the euro, which is down about 10% over the similar period. So maybe you could say half of the decline of the rupee has been due to some extent the strength of the dollar, but there's half or more which is due to the own domestic factors in India. In fact, if one compares the rupee to other Asian countries, the rupees underperformed them significantly.